I'm Dr. Cheryl Dunn, and I'm here to demonstrate a financial accounting problem for a company called Lotsa Linguine Inc. And in this problem, we are asked to calculate the net operating cash flows for a company. So take a look at the problem. With the information we're given, we realize that we need to use the indirect method for calculating the operating cash flows. We don't have enough information to use the direct method. So we use what we're given. We start with net income. And this was given to us as $275,000. We then add back any non-cash expenses. In this case, we do have depreciation expense, which is a non-cash expense. In other words, it's an expense that was subtracted in calculating the net income, and yet it didn't correspond to a cash outflow during the time period. So if we're going to convert this net income number into a cash flow number, we need to remove any items that didn't involve cash, and the depreciation expense would not have involved cash. So we add that back, and that's $25,000. Next, we look at the changes in the different current asset and current liability accounts that the problem gave us. The first one is accounts receivable. Accounts receivable is a current asset, and in this case, the current asset accounts receivable went down. What that means to us is we know that we received more cash from our customers than the additional credit sales that we made. Because if you think about accounts receivable, what increases an account receivable are the sales that we debit accounts receivable and credit sales for. And what decreases accounts receivable are the cash collections on those receivables. And so if accounts receivable overall went down, that means that the cash collections exceeded the sales. Now, if we also had sales returns or if we had accounts receivable write-offs given to us, we would also have to factor in the effect of those on our accounts receivable. But in this case, we weren't given any of that information, and so we assumed that the only things that affected our accounts receivable during the time period were the additional sales we made and the cash we collected. And since it went down, that means the cash collected was more, and so that difference, that amount by which it went down, we say is an additional source of cash that was not captured in net income. The sales were captured in net income, but the cash collections were not captured in net income to the extent that they exceeded the sales amount. And so since they exceeded the sales amount, in this case by $20,000, we're going to add that decrease in accounts receivable. So we add another $20,000 in calculating our operating cash flows. The other account that we're given is accounts payable, and we're told that accounts payable decreased by $30,000. Well, if we think about the accounts payable account, what increases accounts payable is when we make additional purchases. So when we make additional purchases, we credit accounts payable for that amount and debit the purchases account. And what decreases our accounts payable account is the payments that we make on account. And so we would credit cash and debit the accounts payable. If accounts payable decreased, that means the payments exceeded the purchases. And so we used more cash than what was captured in the net income number. And so we need to subtract that decrease of $30,000 in accounts payable. These were the only pieces of information we were given relative to the operating cash flows and the net income of this company. Therefore, we simply net all of these together, and so we end up with $290,000 as the net cash inflow from operations or operating activities, whichever way you want to say it. So that's the answer to this problem. I thank you for viewing this demonstration, and I hope you found it helpful.